Starting off with the income statement and balance sheet. The income statement and balance sheet are your base financial statements. These are important, and understanding how to read them is essential if you're going to be investing in stocks and making decisions more independently. So let's walk you through some examples. With the income statement, starting at the top, you can see your revenue. A lot of times the businesses will detail out what parts of the business is generating the revenue. That's so you can understand, where the income came from, and so they can provide you with forecasts and KPIs that are linked to that area, so both of you can clearly understand what produced that result. From there, they'll get into their operating costs and expenses. These categories tend to be a little more standardized across industries, or at least will be similar among comparable companies. In fact, making comparisons in terms of the percentages that each category contributes to the overall spend happens quite regularly. And as an analyst, you want to know how the company compares to its peers, so that way you can understand if they're spending too much in one area, or maybe they need to increase spending in another area. When you subtract your expenses from your revenue, you arrive at your EBIT, or your earnings before interest and taxes. Occasionally you'll also hear the term EBITDA, which is like EBIT but without depreciation and amortization. You can think of depreciation kind of like a car payment, but with a little bit of a twist. When you buy a car, you get a monthly payment, and it lasts for a certain number of periods, say 60. So for 60 months, you have to make the same payment in order to pay it off. Well, with depreciation, you actually spend the money up front. Like if the car is $40,000, you spend the $40,000, but as a business, the government allows you to recognize that expense in your finances based on the useful life of that asset. So if the car is expected to last 8 years, and 8 years is 96 months, you'd recognize that expense at $416.70 per month rather than that full upfront cost. Now you can do that if you're a business and you're spending money on assets that are productive and that you're getting a use out of. There are rules and regulations surrounding how you have to maintain your books in order to do that, but the reason you'd remove that to find your EBITDA is to see the operations net result. And did they produce a gain or a loss? From there, they'll pull out their interest expense as well as their taxes in order to arrive at their net income. Now, your dividends come from net income, so if you're investing in a dividend-paying stock, be sure to closely monitor their income statement. If the company is not profitable, dividends cannot be maintained. Then in this particular statement, the corporation also included their stock information, so you can see here their net income per share, as well as their total number of shares outstanding. When it comes to the balance sheet, this statement is all about understanding assets, liabilities, and shareholders' equity. At the top, you've got your assets, which are things like cash, inventory, property, and equipment, maybe even deferred tax credits, things of that nature. Then you have your liabilities, which are like your accounts payable, your long-term debt, your lease liabilities, and since I mentioned tax credits, from a liability standpoint, you could also include deferred taxes. Then with shareholders' equity, this represents the common stock that you have currently outstanding and your overall equity or deficit. So if the company is running a deficit, then be careful. If you're still interested in purchasing their stock, then be sure to read their annual report and their press releases to understand why there's a deficit and what they're doing about getting back into a positive equity position.